Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, stock futures pushing higher this morning amid temporary tariff relief from the White House. The exclusions published late last week narrow the scope of trade levies by excluding smartphones, laptop computers, hard drives, computer processors, and more from President Trump's sweeping tariffs on imports from countries like China and India. Shares of Apple and Nvidia powering higher today on the back of the news, despite a warning from Trump that sectoral tariffs will soon hit those exempt technology products.
Plus, Goldman Sachs shares powering higher after its stock traders posted their highest quarterly revenue haul on record. The bank joining peers like Morgan Stanley and JP Morgan, who also posted record trading hauls induced by market volatility. Meanwhile, Goldman Sachs CEO David Solomon saying the bank is entering into a very different environment for the second quarter, but he's confident in its ability to serve clients.
And Meta's blockbuster antitrust trial kicking off today. The social media company will face off against the FTC in a high-stakes trial that could result in the company divesting Instagram and WhatsApp. Kicking off in Washington, it is expected to last weeks and centers around the FTC's allegations that Meta monopolizes the personal social networking market following its acquisitions of Instagram and WhatsApp. Meta CEO Mark Zuckerberg and former COO Sheryl Sandberg are expected to take the stand at the trial as they argue that they are not a monopoly. The latest update in the trade war, tech getting a potential reprieve from the Trump administration, though it could be short-lived. Smartphones, computers, and consumer electronics will be exempt from those reciprocal tariffs that were announced on April 2nd. However, the tech products will face separate sectoral levies in a month or two. That's according to Commerce Secretary Howard Lutnick. The president also chiming in on Truth Social, saying nobody is getting off the hook. The sectoral tariffs on tech will be determined following an investigation under Section 232 trade law. This is the same law that was used to determine the tariff rate on steel and aluminum, which is at 25%. That's a markedly lower rate than the country-by-country reciprocal tariffs originally thought to be imposed on tech. Tech stocks moving higher on this news. Meantime, China retaliating by pausing exports of rare earth metals central to productions for things like cars and chips. The U.S. will now move to stockpile these metals.
U.S. stock futures pushing higher off the back of President Trump's tariff exemption announcement for technology products. But how long can the optimism on Wall Street last as the president says tariffs will be coming for the sector? Joining us now, we've got Yahoo Finance markets reporter Josh Schaefer here. Okay, so Josh, from the street's expectations, how long can some of the fervor for buying on the dip that we've seen enter into the fray continue to move forward?
Yeah, Brett, I think what we have here, at least this morning, is kind of a classic better than feared. We talk about that a lot when it comes to news that you hear about different stocks, right? And I think Wedbush's Dan Ives put that well over the weekend. Dan Ives, of course, a tech analyst, him saying essentially this takes the worst case scenario off for a lot of these tech companies. So some of these products, Maddie was just talking about computers, smartphones, et cetera. Okay, they're not going to get 145% tariff. That's probably marketably good news, right? But they're going to get some tariff. And so what is that tariff actually going to be? What products is it specifically going to be on? Again, we sort of are left with this looming question. One thing I'm sort of writing this morning, and I took away from some of the research over the weekend, several Forrest Gump quotes in research over the weekend, and I actually think it's pretty fitting.
Well, life is like a box of chocolates? Like what?
You never know what you're going to get with the tariffs,
Okay.
Brad. I think that's a little bit what I felt like this weekend, though, right? Saturday morning, you look online, and it looks like, okay, all of these products are exempt. Then by Sunday, you see the president posting on Truth Social, and those products aren't actually exempt, and I think that's why you're seeing, yes, a rally this morning, but still not a rally to the point where strategists across Wall Street are feeling confident in the path higher. A lot of people talking about potentially trading in a range between maybe 5,000 to 5,500 on the S&P 500 as we sort of wait and see and figure this out. The administration has made clear we are not really at the end of knowing what these tariffs are at this point.
But never knowing what you're going to get is a worst nightmare for companies, especially as we are now officially in the second quarter earnings cycle. What do you anticipate hearing from companies who have no real certainty at this time and are trying to deliver forward guidance in a time where in one weekend, you have to update your story multiple times because tariffs are constantly changing?
Yeah, I mean, I was speaking to Kevin Gordon over at Schwab on Friday, and he was saying that he sort of argued, what can you really expect to hear from companies? Essentially saying that he doesn't feel like we're going to get a lot of good data from companies and a good understanding because they don't know either, and it's just simply a moving target at this point. I thought Data Track Research pointed out an interesting thing though, Maddie, when it comes to earnings, and we keep talking about guidance and what are these companies going to say about the full year, but Nick Colas over there was highlighting this morning the importance of companies still beating earnings expectations for the first quarter. Essentially saying, don't forget that the actual numbers they're reporting for the first quarter do matter, and when we're talking about bear versus bull market, what sort of market are we in, what environment are we in? Well, typically the S&P 500 companies beat earnings by about 6% for the quarter that they're reporting, that first quarter. And he was sort of arguing you still want to see that health going into whatever this tariff uncertainty is. And it's similar to economic data we've been talking about too, right? You want to see companies were in a good position before we enter this moment of uncertainty, and perhaps not losing that perspective over the next couple of weeks too of, okay, where were we before we started this? And if we're not going to get clarity, people are just going to pull guidance. At least maybe we have a solid understanding that we were on good footing before whatever is happening, and then we start getting into the chocolate comparisons, and maybe the chocolate will be bitter or maybe it will be sweet. I guess we'll find out.
All right. Well, I got a box of chocolates on my desk that I still got to work through.
We got to test them out, Brad.
Yeah,
we'll see what kind of tariffs we'll get.
Josh, thanks so much. Treasury yields, they are on the move right now to start the trading week, moving lower after a bond market sell-off that followed President Trump's implementation of high tariffs. For more on the latest moves in the bond market, we've got Kevin Flanagan, good friend of the show. He's also the Wisdom Tree head of fixed income strategy. Good to have you back on here with us, Kevin. So just take us into the induction of the sell-off, inducing of the sell-off here, driven by some of the tariff policy, and how much longer you're kind of pricing in for that continued play out.
Well, typically, and thanks for having me on again, typically, what you see is not just one headline or one factor. It's a variety of forces. And I think that's what we saw this time around. It was a confluence of events, of factors. First off, you get that reversal of that flight to quality trade. Remember, when the April 2nd announcement came out, Treasury yields actually dropped to 3.86% as a low. So we have that reversal. Then you have bets that would continue to move forward. They have to be unwind. Some would call that the basis trade that you hear a lot about, whether it's trying to trade on discrepancies between cash and futures prices. I don't want to go too far down that rabbit hole. And then I think there was just some outright selling to raise cash. And I think the bond market got through that turbulence now and is trying to find its footing. So I think the worst is probably behind us in terms of the turbulence. And the Fed has a variety of tools at their disposal to help things out. Not rate cuts, using their balance sheet to try to smooth things out if need be.
So it sounds like you think that the Fed could potentially intervene here. What makes you think that, just given the fact that we've heard from several members of the Fed saying that they don't really have an interest to come in and fix a problem caused by the White House?
Yeah, not yet. So, the way you look at this is go to the funding markets, the plumbing. The funding markets are so important. We saw this in the financial crisis during COVID. If the Fed feels that there's dislocations that are becoming more widespread and trading in the Treasury market does get to be a lot worse than what we saw last week, then the Fed comes in. So right now, I think they're going to hold back, keep their powder dry. But I think the messaging we got on Friday, I think it was from Boston Fed President Collins, that the Fed is ready to prepare. That's all you're going to get for now, unless things worsen up.
Kevin, to the extent that we can track it, what is some of the kind of international buy-in to U.S. bonds, U.S. treasuries, as related to kind of normalized periods? Because that's certainly one way that countries can also interact with each other during a trade war, is purchasing or selling of bonds into the market as well. So I just wonder what you're seeing kind of on this case basis versus what a normalized period might look like.
Well, unfortunately, the official data comes with a 1-month lag. So this is going to be a lot of Monday morning quarterbacking when we get the actual numbers from the Treasury Department. But the way that I would look at this is that, yes, China holds, I think 700 or 800 billion in treasuries. But if you think about it, it works against them. If they were to become active sellers, what does that do to their own portfolio? They would perhaps have to incur losses. What do they do to the dollars? Where do they reinvest them? So I think at this point in time, that's probably blown a little bit out of proportion. I think treasuries are still the mainstay of the global fixed income markets, and I don't see any active selling. We have seen, and an orderly decline or liquidation in treasuries from Japan, from China over the last year. And remember, during that time frame, we had rallies, we had sell-offs. So I think that's the best way of looking at it for now.
Are you concerned at all that there's a risk of investors starting to boycott America? Obviously, selling off treasuries as one risk, but also if you take a look at the dollar at its lowest level since, I believe, 2022 this morning and continuing to move to the downside. Does that present a investment portfolio to you that looks like people are looking outside of the U.S.?
I think temporarily, more of a knee-jerk reaction. I would not expect it to be sort of this renewed trend out of dollars. Because I go back to sort of that question before, to where? Where are you going to go? You're going to go to Japan? You're going to go to the EU?
Maybe.
China? I mean, where is that store of value? So I think, over the course of the last few decades, you get these hiccups in the markets, and then it comes back where the dollar, where treasuries still remain the place to go to for global investors.
All right, well, we will see if that turnaround takes place on the tape. Thank you so much for joining us, Kevin. Appreciate it.
Thanks a lot.
Well, Goldman Sachs topping first quarter expectations boosted by record equity trading revenue up 27% from a year earlier. Joining us now, David Ellison, Hennessy Funds Portfolio Manager. David, great to speak with you this morning. Talk to me about that trading revenue beat in equities, the best results we've seen since 2008. How did Goldman win to that degree?
Well, I think they've, I don't know exactly, but I think that, they're getting back to their core franchise. They drifted off there for a while trying to get into consumer finance. But I think now they're back to, in a sense, their core strengths. And I think they're hiring the right people and they're getting the results.
So with that in mind, as you think about what they're kind of classifying right now and what they're looking towards in this environment to really kind of pull the levers of their business that would best suit navigating what some of the other bank CEOs have talked about in foreseeable or considerable turbulence were the words that Jamie Dimon used when they reported earnings. How is Goldman positioned differently to navigate if they don't lean into such a heavy consumer product focus and instead rest on some of their laurels, such as trading, such as wealth management even, and how can that continue to kind of buoy the ship in this near term?
Well, I think historically, that's been their strength. So it's been, trading, investment banking, sales and trading, all those things. And that's been their strength. And I think they do it better than most everybody else. And I think that they'll be fine. I think the issue is sort of where the economy is going to go. And things have obviously changed a lot in the last, 30 days or so, or last 20 days, or maybe the last 2 hours. But I think these are the types of companies, Goldman is a good example of a company that will adapt. I don't know exactly how, but, I've adapted to the business that I'm in. It has changed over the years and they'll do the same. And I think that, recessions are not bad for them. Recoveries aren't bad for them if they manage it right. So I think you get back to sort of what do you want to buy in this environment?
Yeah.
You buy well-run companies and let them figure it out and let them do the hard work to get to the other side.
And just some context for our audience, we've been reporting on how a growth area for Goldman moving forward is their wealth management business. Executives have been pointing to that as a growth area over the past several quarters. I do want to point out, though, something that David Solomon, Goldman Sachs CEO, said here, saying that we are entering the second quarter with a markedly different operating environment than earlier this year. That came in the statement this morning. What do you make of him avoiding the big T word there and instead talking about this as just a markedly different environment?
Well, I guess it's, it may be, the politically correct thing to do, but I think it's, it's more than tariffs. It's, it's what's going to happen to the labor pool in the United States, what's going to happen to the M&A activity that he's going to see or be allowed to do, let's say in the banking industry or all the other industries that are sort of being deregulated. So there's a lot of other things happening and that are unrelated to tariffs. Tariff seems to be the thing that everybody's talking about now. But I think the issue now is, things are a lot different. So the question is, how are you going to adapt to that? So I'm not trying to be, the guy that thinks, that everything's going to be great, but I think the companies will adapt and they'll adjust. And I think our job as PMs and as analysts is to try to figure out which companies are going to be willing to do that and make the adjustments and hang on and see what happens.
David, thanks for taking the time here this morning. Appreciate it.
You're welcome.
Coming up on Morning Brief, we count you down to the opening bell on Wall Street. Plus, we check in on Meta shares as the company prepares to kick off its blockbuster antitrust trial. And Apple relying and rallying on the back of tariff exemptions. We break down what that temporary relief means for the iPhone maker next on Morning Brief. Tech stocks are higher today after shifting messages from the Trump administration over the weekend. According to the latest developments, smartphones, computers, and other consumer electronics will be exempt from President Trump's reciprocal tariffs, but the tech products will face sector-specific levies in the near future. Joining us now, we've got Tom Forte, who is the Maxim Group Managing Director and Senior Consumer Internet Analyst. Tom, good to see you this morning. So how are you making sense of the tariffs on tech right now and who it's going to impact the most?
Yeah, so stepping back for a minute, I think we're in a very fluid situation. I think the strategy that President Trump is employing here is he's trying to reduce the trade deficit, he's trying to reduce the budget deficit, he's trying to bring some manufacturing back to the US. The challenge for everyone is to try to determine what does this look like on a near-term basis and what does this look like on a long-term basis. So I think that when it comes to Apple, Tim Cook has a wonderful relationship with President Trump, also has a wonderful relationship with President Xi. But it isn't clear to me at this point in time what the ultimate outcome for Apple will be, but I would almost view the exemption on smartphones as semi-permanent, meaning that I think that there is going to be some sort of exemption as it pertains to smartphones and things made out of China. And my overriding view is that the market's view of Apple's shares has been too negative, that the outcome may be less bad than feared, and this is an example of that.
So Tom, as you note, over the weekend, there was a little bit of whiplash, right? We had this reporting that the reciprocal tariffs were off for smartphones, computers, a lot of tech products, but then President Trump and Secretary Howard Lutnick saying sectoral tariffs are on and they're coming in the next month or two. Where does that net out for Apple? I hear you saying you think there's going to be a smartphone exemption, but did I misread President Trump's post talking about how nobody would be off the hook here? You still think there's going to be that exemption?
Yeah, so I'm glad you used the term whiplash. So as someone who's followed the industry since '96, I feel like I have whiplash and indigestion. I mean, it's a very challenging market right now. I think that one of the reasons, though, the market is so challenging is it's responding to every headline, and it's not thinking about what's beyond the headlines, what's the ultimate strategy here. And the ultimate strategy here is I think when we say tariffs, we really should say trade negotiations. This is a trade negotiation going on between US and China. It isn't clear to me what the ultimate trade deal might look like, but this is a negotiation. You've seen it on both sides. So you had the original tariff announcements by President Trump, you had retaliatory response by China, and there's been a bit of a back and forth. So I think that it's better to frame it as a trade negotiation rather than to look at each individual headline and assume that's the final outcome.
Tom, Apple was one of the names to actually lead lower and start off its trend lower to start off 2025. And as we're thinking about what the tariff implications have meant and the whipsaw type of action and the lack of clarity, is relief of it not being as bad as expected enough to get it back to all-time highs, or does there need to be some other major catalyst for the stock?
Yes, I think, Brad, what you're pointing to is that earlier this year, Apple's shares lost their momentum because the AI trade in Apple was muddied. So this expectation of an AI-led upgrade cycle for the iPhone hasn't really played out. So I would say that first we're going to have to figure out how Apple's going to address this overweight to China. They're too dependent on China from a supply chain standpoint. And then for it to really regain its all-time highs, I think we're going to have to see that either the upgrade cycle is in place or just that Apple can continue to innovate so that 5 years from now, the smartphone will still represent half their revenue and it'll be a strong performing line for Apple.
And talk to me about your rating on Apple, because you sound pretty bullish, Tom, but you've still got a hold. What does it take to get you back to a buy?
Yeah, so I do have a hold rating and a $215 target. The challenge right now is to try to determine, as always, what is the appropriate multiple to pay for shares of Apple given the current market environment. Our $215 target has a 28 times multiple. So for me to get bullish, I would have to see a situation where I felt like the market had overreacted, sold off shares Apple too significantly, and that the sentiment was too negative, even with the challenges in China, and then longer term, the challenges on the overdependence on the iPhone.
Tom, I know that you've kind of evaluated as well some of the trends that are showing up, and IDC saying that worldwide smartphone market, it's forecasted to grow by 2.3% in 2025, but it's not led by Apple iOS or Apple operating software or that ecosystem. It's Android growth in China and the US that's anticipated to really drive that. So what does Apple need to do, and who are some of the other competitors that we're seeing continue to be able to take share at this moment, making it more difficult for Apple and their pricing power as well?
So within China, Huawei is certainly doing much better than it's been doing in a long time. You saw that in the 10% decline in Apple's revenue in China. That was influenced by the local smartphone manufacturers there, including Huawei. Samsung's doing well as well. I appreciate your comments on Android. And I think that the challenge here for Apple is that it needs to continue to find reasons for consumers to buy their smartphones. And I think that, clearly it's not AI, but what if it's form factor? What if a foldable iPhone ends up being, the stimulant or things of that nature?
No,
so I think that
I don't want a
sometimes we
foldable
get too hung
iPhone,
up
Tom.
on AI.
I don't want a foldable iPhone, Tom. I don't know if it's just me or if I'm just, this is like my
You don't want a
old-
larger screen, Brad?
This
so
is-
ultimately, it'd be a smaller in your pocket, but a bigger screen to enjoy.
So I could watch
Think of it
Rory
that
win the
way.
Masters on that when I'm on the go. Yeah, totally. All right. But this is one of my grandpa on the porch type moments for sure. Maybe I'll come off of it at some point. Thanks, Tom.
You're welcome. Thanks, Brad.
Thank you so much, Tom. Appreciate it.
Thank you.
Well, Nvidia announcing a big investment in the U.S. The chipmaker says it's working with manufacturing partners to design and build factories that will produce its AI supercomputers entirely in the United States. Nvidia has commissioned more than 1 million square feet of manufacturing space to build and test Nvidia Blackwell chips, both in Arizona and then AI supercomputers over in Texas. Within the next 4 years, Nvidia will produce up to $500 billion of AI infrastructure in the U.S. through partnerships with TSMC, Foxconn, and others. I do want to just run through a couple of the bullet points from this announcement here. Nvidia Blackwell chips, again, have already started production in Phoenix, Arizona, building that supercomputer in Texas with Foxconn in Houston and then with Wistron in Dallas. Mass production of both plants expected to ramp up in the next year to 15 months. And then within the next 4 years, that AI supercomputer putting $500 billion of AI infrastructure in the United States through some of those partnerships, talking about the world's leading companies deepening their partnerships with Nvidia, growing their businesses while expanding the global footprint here. And then quickly just want to point out a quote from CEO Jensen Huang saying the engines of the world's AI infrastructure are being built in the United States for the first time. I think that exact quote, something that the president has been looking for from these executives.
Yeah, of course, Hanhai, the parent company of Foxconn, and Hanhai shares, actually the American Depository receipts, we're seeing jumping by about 16%. Also within that mix is the share buyback that they announced. But this is major news for Foxconn, who has tried to entrench itself just a little bit more here, U.S. domestic production-wise, and of course tried to get the attention, especially amid a trade war, how much more difficult that is for some of the foreign entities to try and woo President Trump, who in some facets has kind of rolled out the red carpet to say, hey, if you're going to invest heavily in us, then we will, accept those dollars and we'll see what kind of fast tracking for any regulatory approvals we can give you. So that's been interesting to track in combination with some of the partnerships that have been raised here.
And I just want to quickly want to point out the last sentence of this announcement from Nvidia. They're talking about building robots to automate manufacturing. That does not sound like bringing manufacturing jobs back to the United States. We're going to have all your markets action ahead. Stay tuned. You're watching Morning Brief.
There you're taking a look at the opening bell at the New York Stock Exchange and at the NASDAQ. Great bell ringers on both sides as we're taking a look at some funfetti to kick off this trading week, because last trading week was the longest month ever. Let's take a look at how things open up on the day as we're taking a look at the Dow Jones Industrial Average. We have a jump there to start the day of about 1.2%. There's the year-to-date context here, and let's take us to the last 5 trading sessions here as we're net positive by about 7.25% over those sessions here. The NASDAQ composite, you're seeing that right now open up the day higher. The S&P 500, that too, up by about 1.8% to begin today's trading activity. So let's check in on the sector activity as we begin a new trading week here. We are higher across the board right now, led in a big way by technology. You're seeing that up 3% here, and all 11 S&P 500 sectors are in positive territory. Since we're talking about technology, let's keep on that train. Taking a look at the NASDAQ 100 tech-heavy average here. This, of course, just a fraction of the 3,000 plus companies that are listed on the NASDAQ, which makes up the NASDAQ composite. But this is their NASDAQ 100 here, and we're taking a look at some of those mega cap tech stocks, all jumping in a big way. Some of the exemptions from the Trump administration on the tariff tit for tat that has been rolling out, well, ultimately some of the rollback, if you want to call it that, impacting some of those tech stocks in a good way. Apple right now jumping the most of those Mag 7 names. That's up by about 7% to begin today's trading action. You're also seeing, and it's going to be a big day for Meta, as it seems like there's going to be even more of the spotlight that focuses in on them and their social media entities. We will see exactly how that rattles through DC over the course of this week as well. And then additionally, taking a look at Tesla here. Let's jump into that name and load up this chart here for you. I'd love to populate these charts for you. Why not? Let's take a look at it year to date. We're down 35% year to date, but still higher, starting off the day up by about 3% there. With that, and a deeper dive on today's early tape, let's get on over to Yahoo Finance's Jared Blickery for a look at what's moving. Hey, Jared.
Thank you, Brad. I agree. Last week was one of the longest months on record, at least psychologically speaking. Let's start with the NASDAQ, because last week was the best in a couple of years, since 2022. I use the term best in scare quotes because it was a rocky ride. We had a great Wednesday, difficult Thursday, and it's just kind of been like that lately, where we have a big up day followed by a big down day. Nevertheless, in the S&P 500 and the other majors, we are seeing realized volatility. That is the average daily trading range. That is contracting just a little bit. We did get about 6 straight days of 5% moves, which is absolutely huge, but it seems to be we're coming off of that boil. So an important maybe inflection. It would be nice to get some stability, because that would facilitate a move upwards. Here's a 10-year T-note yield. Speaking of best weeks, we had a huge jump. In fact, it was the biggest one last week since 2001. Today we're going in the opposite direction, which is down just a little bit, about 6 basis points. But on this year-to-date chart, you can see that was a pretty big jump last week. And the U.S. dollar index is bouncing off multi-year lows here. And trading ranges in the dollar are pretty important. And a lot of times you'll see a break of the trading range only to see it get sucked back inside. And so my thinking is that that might be what's happening this time. So we might see another rally in the dollar. But if we keep going down, that's going to mean something a little bit different. And just going to mention again that the relationship between the dollar and yields tends to be inverse. One goes up, the other goes down, which is in direct contrast to what we've seen for the most part through the bull market that began in October of 2022. All right, looking at the sector action, tech is leading, energy is in second place. Also interesting, because a lot of times over the bull market we'd see tech leading while energy was lagging, or vice versa, but now they're moving in concert. So just more evidence that things are quite a bit different nowadays. And then looking at the screen, Brad was breaking down the NASDAQ 100 before. Apple having its second best day of the year. Guess what the first was? That was last Wednesday, when everything went up by a ridiculous amount. Nevertheless, Apple kind of looking like the major indices, where it has climbed right back up to that level at which it broke down from only a few weeks ago. So that's where the rubber meets the road here. So big test for Apple today and the coming days. And then we want to check out gold here, because gold had its second best week of the century last week, and gold has just been extremely strong. See if I can find it's going in the opposite direction today, which is about 1% down. But this is a year-to-date chart. You can see it's up 21%, and we hit a record high almost at 32.50, I believe, only last week. I'm going to close with Bitcoin, which hasn't been terribly active, although we saw a couple big up days last week along with everything else, and it was holding 85,000. It has slipped below that number right now, but importantly, it's just kind of meandering around trying to find its footing here. I'm not going to think too much of the price action until it's able to climb above 90,000 or until it dips below 75,000 again. So again, just in a trading range with respect to Bitcoin. Maddie?
Jared, thank you so much as always. It's time now for today's strategy session. U.S. stocks opening higher amid recent trade war-induced volatility. But our next guest says do not buy the dip. Here to break down why, Alex Morris, FM Investments CEO and CIO. So, Alex, I don't know if you can call the action we're seeing this morning dip buying necessarily, but regardless, you would say don't do that. Why?
Well, I think folks shouldn't have jumped out of the market, right? If you did, you should just be easing back into it. This isn't necessarily the moment to put everything back in the market. And it's simply because what you're seeing now is some great optimism in the markets today, right? There's a lot of reasons to be pessimistic, and yet, despite calling all of us cynics, here we are with a bunch of green across the boards. A little bit of greed, but realistically, I think if you jumped out, you're going to see more volatility. And picking any point in time, just roll the dice and pick one. So you might as well just stick to your asset allocation and rebalance slowly back to where you want to be, because you're going to see a lot of things happen between now and the end of the session and now and the end of the week and the end of the month, and they're all going to be quite different.
Somewhere around 80% of this market is trading below its 200-day moving average. Where are the opportunities that you can't avoid, even knowing that pullback that's baked in right now?
So we still like being along the bonds, and we like being along the short end of the yield curve. So something like T-bill, we like ultra short tip, something like our bill that's out there, which we launched recently to help folks really capture that inflation protection. Because if we take away the T word for a few seconds, forget the dog year that was last week, we still have a lot of other things in the market that we're still fighting. We still have unemployment numbers that are pretty strong. We have inflation that, although it missed by a little bit, fears are pretty high. And we really need to stay focused on those primary factors. Tariffs as controlled by Donald Trump and the roll forward, roll back, roll around in the mud, whatever it may be, are all going to happen, and we can't stop that. And as we've seen in the last week, if you're not hovering with your finger over the mouse at that exact second, you can't check that opportunity. So probably better to just stick in what works. And right now, that's also fixed income.
Where, though, within fixed income, especially given the underperformance that we've seen of the 60-40 portfolio here, continuing to underperform with just a 2% annual return since 2022. And you can see that dip in the bottom of your screen here just to indicate the most recent underperformance of that 60-40 portfolio. So then where do you find the best area of exposure along the yield curve to protect your portfolio?
Right now, we think that's on the shorter end. So whether that's within a year, which will give you a nice 4% yield or better still, but folks are going to need to start working into those 2s, 3s, and 5s in the coming months, as that duration will help. We do think the Fed has made clear they're not interested in intervening in a market yet, but we do know they are ready if need be, which is where you'll want to be in the middle of the curve, or as their metrics are hit for their dual mandate, which they're making clear are getting closer. They're just not there yet.
What would the Fed intervening in the market look like? How do you kind of run the calculus around how that would play out?
I think the market has said we think there'll be 4 or 5 cuts of a quarter basis point each. And our theory is if the Fed had to intervene, it would be a Sunday night, pretty much elevator ride to zero. Like they're not coming in at half measure at that point. They're coming in because they see we're running into the wall and they need to stop us. They've been working for 5-6 years now to restore credibility to the central banking theory that interest rates can politely and effectively control the economy. To step back in because something's going wrong isn't going to be piecewise function. It's going to be an immediate drop.
But doesn't the self-induced tariff policy almost make transitory a reality once again for the Fed?
Well, I think the Fed, although Jerome Powell did use the word transitory, which I would have thought he'd put a moratorium on anyone saying that word. It becomes an issue until the exact rollback happens, and then it's not an issue. So I think the Fed's theory is they're not going to fight policy because they can't influence it. If anything, they're looking to fortress themselves against Donald Trump turning his wrath on them, which, let's not forget, 2 or 3 weeks before the tariff war started, we were worried that Jerome Powell might get fired. And what would that mean?
Which he can't legally.
Right.
We can't legally, and he made that very clear, but the White House may have other opinions about that, and I'm hoping we don't find out.
Well, let's end where we started, which is on today's market action and what we've seen most recently in terms of any rally here. I'm curious, Are you thinking of any day that we're seeing the major averages in the green just as a sign that we're seeing kind of hedge funds covering their shorts? Or is any relief rally like this something that investors can really start to believe in? And how do you tell the difference?
I think you can only really tell the difference after the fact, which is unfortunate for investors, but that's why we like folks to stay in the market, right? It's time in market, not timing the market that really matters. But here I think you're seeing some optimism from folks saying, okay, if the tariff nonsense is behind us for at least a few months, right? I don't know if we can buy 90 days, then it's safe to get back in. But just to be clear, we didn't say tariffs are going away. We said in 90 days, we might be back in this exact same mess. And the hope I think investors have to rest on is that there are a lot of folks in Washington, not just in the Oval Office, who need this to work out, and they're working hard towards that solution.
FM Investments CEO and CIO Alex Morse, thanks so much for taking the time.
Thank you.
Appreciate it. You're watching some live footage of Blue Origin's first all-female flight. The star-studded crew includes Gayle King, Katy Perry, Jeff Bezos' fiancée, Lauren Sanchez. The launch took Blue Origin's New Shepard launch vehicle roughly 62 miles above Earth's surface beyond the internationally recognized boundary of space. Today's launch is New Shepard's 11th human flight. These are some remarkable images that we're seeing as it looks like they're making a safe touchdown back to planet Earth. And we've got a lot of stories that might be told after this as well, Maddie.
Yeah, I'm very excited to hear from the folks who were on that spacecraft. There are obviously celebrities like Katy Perry and Gayle King, but also some other folks, Amanda Yin, who is an advocate for sexual abuse survivors and also a scientist herself, some other NASA scientists on board, and a producer, I believe, as well here. And as you can see, great news. It does appear at the moment that they have crashed down safely, at least for the time being. And we will, of course, continue to report on this. We're going to be speaking with someone about how you can invest in the space later on in the 10 a.m. hour as well.
Excellent. Well, the future of Meta's social media empire hangs in the balance as a landmark antitrust trial gets underway. More on what's at stake next on Morning Brief.
Big tech has made efforts to be cozier with the second Trump administration that hasn't paid off in the stock market. Meta, Google, and Amazon all donated $1 million to Trump's inaugural fund. Apple's Tim Cook made a personal donation of the same amount. Elon Musk donated roughly $288 million to President Trump's campaign. That's according to the Washington Post. Now, for comparison, Google, Apple, and Amazon also donated to President Biden's 2021 inaugural fund, though they gave far less. Leaders of all five companies attended Trump's inauguration, seated on the inaugural platform with better views than some cabinet appointees.
Since January 20th, shares of all five companies have fallen double digits. President Trump's trade policies and the emergence of China's low-cost AI platform DeepSeek in late January have rattled both tech and the broader market. Shares of Tesla have seen the steepest declines, down more than 40% since the inauguration. CEO Elon Musk has become a close ally of the president, spearheading the Doge initiative and weighing in on trade and tech policy. Wall Street sees that as a risk to Tesla. Longtime bull Dan Ives from Wedbush was one of several analysts to slash his price target on the stock, citing Musk's politics as a risk for the company's future.
Well, the Federal Trade Commission's antitrust case against Meta begins on Monday with opening statements from both sides. At stake, the future of Meta's social media empire. The FTC is arguing that the tech giant illegally maintained a monopoly in the social media market by acquiring both Instagram and WhatsApp. Meta is arguing that the FTC gave its blessing back when the deals were initially made, and that the social media market is far from a monopoly, thanks to competition from the likes of TikTok. The trial's outcome could have big implications for big tech acquisitions. Joining us to discuss, Adam Kovacevich. He is the Chamber of Progress's CEO and founder. Adam, great to speak with you here. Any chance of Instagram, WhatsApp actually getting divested?
Sure, there's a chance. We don't know. I think the judge in this case has said that the FTC has kind of an uphill battle here. They have to do two things. The FTC has to do two things. First, they have to prove that Meta has a monopoly in the relevant market, which the FTC has said is personal social networking. The challenge for the FTC with that is they say that market includes Facebook, Instagram, Snapchat, a company called MeWe, but the FTC says that it does not include LinkedIn, Reddit, X, TikTok, YouTube. And of course, Meta will push back on that, saying that actually the market's much bigger, right? But the second thing that the FTC has to do is they have to prove that Meta's acquisitions of Instagram and WhatsApp helped Meta maintain a monopoly position through unfair competition. And as you said, like these are 11-year-old, 12-year-old acquisitions. In some ways, I think what the government's asking for is a little bit of a do-over here of the regulatory approval that they gave, 11 years ago, 13 years ago.
What does the government really want in terms of some type of defining change to how the company operates here?
Well, it's pretty clear that they want Instagram and WhatsApp to be spun off from Meta. Like that is the clear objective of the case, because they are saying that essentially the acquisitions of these companies 11 years ago, 12 years ago, gave Meta as sort of an unfair position. I think the problem, the most inconvenient fact for the government here is that the FTC looked at both of these acquisitions at the time they were implemented and approved them. And I think it's important to say, like, these were really small companies at the time they were approved, right? You had, something like Instagram had like 3 or 4 million users, and WhatsApp had a very small number of users. Now, under Meta, they've grown those to hundreds of millions of users, right? So Meta is going to say that it provided scope and scale for these services to grow, and that wouldn't have happened if both companies had remained independent.
Yeah. So let's play this out. Say this does go through. Say that the government does get what they want, and there's a split up of some highly valuable assets from Meta Platforms. What does that mean for investors who are trying to figure out what the sum of the parts looks like?
Okay, this is a great question, because there's clear stakes for Meta, right? Like, it would prefer not to have its company broken up, would prefer not to spin off Instagram and WhatsApp. But I think that there's some interesting macro perspectives here, right? Beyond the stakes for Meta, right? First, there's this sort of do-over that the FTC is seeking, right? Companies really ought to be able to take antitrust regulators' approvals of their deals to the bank, right? Meta is apparently going to call some former FTC employees who reviewed these deals the first time, right, to talk about that. And this question sort of looming over the trial is like, look, is every acquisition that's been approved by the DOJ or the FTC going to be subject to kind of like a regulatory do-over, right? But secondly, from the perspective of there's a kind of interesting perspective for both startups and the companies that buy them, right? Getting bought is not most startups' plan A, right? But it is their plan B. And having the FTC undo this deal could put a chill over startups who want to be acquired. For the acquiring companies, it kind of reads like the case is a bit of a penalty for companies kind of doing too good a job of integrating the acquired companies. So I think there's interesting stakes beyond just Meta.
So talk to me then about just how you see this administration. Do you see Trump 2.0 as friendly to big tech, and is the relationship that all of these tech CEOs have tried to foment with the president going to benefit them in a situation like this?
Well, look, this trial started under the first Trump administration, right? And it was then relaunched or refiled under the Biden administration. There was been reporting that Mark Zuckerberg went to go meet with Trump to try to get the government to drop the case. And what's interesting about that is that before Trump, like, no company that was being sued by the FTC would have even bothered talking to the White House about the settlement, because historically the FTC has sort of said, oh, we're an independent agency. But what's interesting is that the FTC chair, Andrew Ferguson, has basically now declared that the FTC is sort of subservient to Trump, right? And so he's kind of opened the door to Meta trying. Now, just because it hasn't been settled yet does not mean it couldn't be settled later, right? It could be settled during the trial. It could be settled after the trial, after the verdict even, right? And if that succeeds, though I think the odds are against it, you're going to see other big tech companies who are in the crosshairs of the government try the same strategy.
Adam, thanks so much for taking the time here with us today. Appreciate it. We're going to be tracking all of the developments. We know you will be too.
Thank you.
We've got all your markets action straight ahead. Stay tuned. You're watching the Morning Brief. We're taking a closer look at some trending tickers this morning. We're doing this in 30 seconds each. We're watching Pfizer, Nvidia, and Intel. First up, Pfizer will stop developing an obesity pill after it was linked to a potential drug-related liver injury in one patient enrolled in a clinical trial. The injury did resolve after the person stopped taking the drug. The company says after reviewing all of the clinical trial data and input from regulators, they are discontinuing the drug. This is a blow to Pfizer as it competes with the likes of Novo Nordisk and Eli Lilly in the weight loss drug space.
Plus, Nvidia announcing a big investment in the U.S. The chipmaker says it's working with manufacturing partners to design and build factories that will produce its AI supercomputers entirely in the States. Nvidia has commissioned more than 1 million square feet of manufacturing space to build and test Nvidia Blackwell chips in Arizona and AI supercomputers in Texas. Within the next 4 years, Nvidia will produce up to $500 billion of AI infrastructure in the U.S. through partnerships with TSMC, Foxconn, and others.
And Intel announcing it has entered into an agreement to sell 51% of its Altera business to tech investing leader Silver Lake Management. The transaction values Altera at $8.75 billion. Intel will continue to hold a 49% stake in the business. The transaction is expected to close in the second half of 2025. Intel also announcing a new CEO for Altera effective May 5th, 2025. The deal is part of Intel's turnaround strategy as it's lost market share in recent years, falling behind the curve in the AI race.
You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Stick around for more. That's going to do it for the morning brief. You can join me in the next hour for more analysis on cows and then Brad on wealth after that.